When the majority zigs, the wise often zag. In the realm of investing, this contrarian approach can not only differentiate the savvy investor from the herd, but can also pave the path to substantial financial gains. The financial markets, fueled by ubiquitous media and rapid information exchange, often resemble a tumultuous ocean where waves of popular opinion crash against the bedrock of fundamental value. It is here, in the frothy wake of market overreactions, that the contrarian investor frequently casts their line, fishing for overlooked opportunities that promise growth and stability beneath the turbulent surface. This essay delves into the art and science of contrarian investing, a strategy that has been wielded with great effect by luminaries such as Benjamin Graham and Warren Buffett. By daring to stand apart from crowd psychology and focusing on intrinsic value, contrarian investors often unlock portfolios of untapped potential. Contrarian investing is not merely a strategy, but a philosophy. It involves going against market trends and sentiment, focusing instead on securities that are undervalued by the market. At the core of contrarian investing lies the fundamental analysis of stocks, identifying companies whose stock prices do not reflect their intrinsic value, often because they are unpopular or have been recently unfavorably impacted by temporary events. The volatility in stock prices, highlighted in the above graph, illustrates points where contrarian opportunities are likely to arise. For instance, a sharp decline in a company's stock due to a scandal or a poor quarterly result might deter the average investor. However, if the company's fundamentals remain strong and it boasts a solid business model, this could represent a potential investment for the contrarian. Investing against the grain requires a rigorous assessment of fundamental indicators like PE ratios, book values, debt levels, profitability, and future growth prospects. It also demands an ironclad emotional discipline, as buying when others are fearfully selling can be psychologically daunting. This leads to an essential attribute of successful contrarian investors: patience. The ability to wait for the market to recognize the true value of an undervalued asset is crucial. Here, time is not just a factor, but an ally. Delving into practical real-life examples, one can look at the aftermath of the 2008 financial crisis. Many financial stocks were beaten down to what many perceived as irreparable levels. However, those with a keen eye for value, like certain hedge funds and private equity investors, recognized the discrepancy between the market price and intrinsic value. By investing heavily in these undervalued assets, they reaped significant returns over the following years as markets normalized. The recovery trajectory of financial stocks post-2008 crisis, as seen in the chart, clearly depicts the contrarian bet paying off as the market gradually adjusted to more rational valuation levels. Another modern example can be found in the realm of technology during market corrections. During the onset of the COVID-19 pandemic, many stellar technology companies experienced a sharp decline in stock prices due to widespread market panic. Contrarian investors, seeing the long-term growth potential and the essential nature of tech services, capitalized on these lower prices. The application of the contrarian approach isn't restricted to just stock markets. In emerging technologies such as green energy and biotechnology, and even in real estate markets across different geographies, the principles of contrarian investing apply. A strategic analysis of cycles, technological advancements, market maturity stages, and regulatory environments is critical. The key is to equip oneself with a thorough understanding of market dynamics and to maintain a vigilant stance, ready to act when the majority misjudges the future. Throughout, the quintessential challenge for a contrarian is not only identifying the right opportunities, but also managing the associated risks. Diversification across sectors, geographical regions, and asset classes plays a protective role, helping to mitigate potential losses. Additionally, maintaining a pulse on global economic indicators and remaining adaptable in the strategy deployment ensures that one can prudently navigate through market sentiments and cycles. As we reflect on the principles and practices of contrarian investing, it is clear that while the path less trodden may hold uncertainties, it also harbors great opportunities for those willing to research deeply, think independently, and invest judiciously. The contrarian strategy, with its emphasis on intrinsic value and critical analysis, offers a compelling framework for those who are not only looking to survive, but thrive in the complex tapestry of global markets.